You're about to hear my conversation with our chief fixed income strategist, Dustin Reed. We talk all about the Bank of Canada, the Fed, how they might react to potential tariffs, and DeepSeek and the impact on markets. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr. I'm your host today, and I'm back with my regular guest, Dustin Reed. Dustin, welcome back.
Hey, Matt. Thanks very much for having me back on.
We had both North American central banks meeting today, the Bank of Canada and the Fed. I'd like to get started the conversation with the Bank of Canada. They cut by 25 basis points, which was widely expected. What did you take away from the meeting?
Yep, you're absolutely right. The bank did do 25 today with the market basically almost fully priced around 22 basis points going into the meeting. And so no surprise just from the big headline. I would say that some of the takeaways from the bank were actually quite interesting. One is that the bank decided to drop its forward guidance, which is effectively, what do we think is going to be happening next, and what's the lean, although never pre-committing, obviously, because many things happen between central bank meetings. But
Sure.
What's the general lean going forward for the next meeting, which happens to be in March of this year. And so the bank dropped its forward guidance, and a lot of people took that to believe that the bank was done with its easing cycle. Now, I think that's probably a bridge too far, although there was a little bit of kind of hawkishness underneath with what the bank was saying. I'll get to that in a sec. But we were sitting here recording on the day of the bank and the Fed, so Wednesday afternoon ahead of this Saturday, February 1st deadline. And I think the bank does not really want to make any big, bold predictions ahead of the first, because that could be, depending on what happens on the tariff front, that can be a very significant directional impact, whether it's kind of, as we would say, kind of right tail or left tail, kind of like risk off left tail or risk on, so to speak, kind of right tail. And it's not quite apples to apples, but it kind of reminded me back in actually, it's far from the same in a way, but early March 2020, when the pandemic was really starting to hit home.
Right.
The Fed decided to not publish its statement of economic projections in March of 2020 because it just didn't know. Because it was unprecedented, shutting down the economy. Now this year is obviously potentially serious. It's obviously not at quite that pandemic level, but I think the bank is doing that and just saying, look, we recognize we're ahead of potentially a big, aggregate demand shock. We don't know if it's going to be one-off or if it's going to be climbing. We just don't know, and we don't want to make that. So there's some people out there that are saying, like, this is the end of the bank's cutting cycle.
Sure.
And I would hold off on that. I would fade that notion. I do think that the bank has been quite optimistic on Canadian growth and the Canadian economy over the last 12 or 18 months. And the forecast today, the January round for the bank is a forecast round with the monetary policy report released. So you get a little bit more information than the non-forecast meetings. And the bank updated its models and still sees growth at a relatively good pace for this year, calendar 25, and in 26. And some people would say that's a little bit optimistic, and the inflation numbers are not high by any stretch, but definitely a little bit, maybe the inflation forecasts are a little bit higher. So again, that kind of feeds into this narrative of, okay, well, maybe the bank is done cutting rates. And again, I would say the bank is generally overestimated on the growth side. And so I would be cautious around that. Another couple of things the bank did, kind of maybe on the side, is the quantitative tightening program is going to be winding up relatively soon. Some people thought that announcement might come in April. It's not a big deal for a lot of investors, but for some investors that are watching very specific things in the short end of the curve, that might have a little bit of an impact. And the bank also actually dropped its deposit rate as opposed to the main bank rate. It dropped its deposit rate by 30 basis points as opposed to the regular 25 that it did for the policy rate, to kind of line up some money market stuff, and have the overnight reverse repo rate a little bit more in line with how the market's trading. So
Okay.
a little bit of cleanup there. But I think the bank here is, I mean, obviously it's waiting for the announcement or whatever what will come from the U.S. Even if, let's assume nothing happens from the U.S., which I don't expect, but let's assume that nothing happens from the U.S. I don't think that the bank's cycle is done yet. And
Right.
the reason I say that is because the Bank Canada rate now with the today's 25 basis point cut is now 3%. The bank's belief is that the neutral rate for the economy is somewhere between 2.25% and 3.25%. So now we're just inside the top end of the range, but not at the middle of what the bank believes is the neutral rate for the economy. So it's neither restrictive nor accommodative. And I think that with inflation relatively steady, and the housing market reset, as I'm sure everybody knows, very much ahead of us here in 2025 and 2026. And the unemployment rate in the high sixes, 3% policy rate to me still seems a little bit high. Maybe not wildly high, but it seems to suggest that the bank can be somewhere, I would say at least in the bottom half of what it thinks is the neutral range, if it actually believes those numbers are still correct. So somewhere
Right.
between 2.25% and 2.75%. So that would seem to suggest that happens. And obviously, if the tariff story becomes a bit of a thing, then I won't say all bets are off, but I mean, you probably have to adjust that a little bit.
Great. Well, let's come back to tariffs, but first I want to ask you about the Fed.
Sure.
What happened in the Fed meeting? Any key takeaways?
Yeah, the Fed meeting was also a little bit interesting. So obviously, the market had been expecting a pause or a skip for a
Right.
while for today's meeting, the January meeting, and this was not a forecast meeting for the Fed. The March meeting will be a forecast meeting. Bank and the Fed kind of, not purposely, but actually kind of trade off on which one's a forecast meeting and which is not. The Fed obviously passed on cutting rates in July. Um, Having obviously come close to cutting rates, but obviously passed on that. Ended up doing 50, of course, in September, 25 just after the election in November, and then another 25 in December. So the Fed's done 100 so far, taking its policy rate to a range. Of course, Fed funds is a range to 4.25 to 4.5, having started 5.25, 5.5. So we're sitting 4.25, 4.5, and no change today, which was expected. Literally zero. Literally zero was priced in actually going into the meeting. The statement was significantly amended in the first paragraph, which is generally the paragraph that talks not necessarily rear view mirror like what's happened, but a lot of Fed watchers do take the first paragraph as kind of what has happened. And they in the previous statement, the Fed, the FOMC technically talked about the idea that inflation was returning closer to its goal, and today it omitted that part of the inflation sentence or statement, and that got a lot of people quite interested in terms of, oh, is the Fed making a 180 on rate cuts? The Fed also was very, very upbeat and positive. I think using the term solid when describing the labor market,
Right.
also in the first paragraph. So that was kind of the statement, which is obviously the most formal thing that the Fed does, was quite, got people thinking that the Fed's looking at potentially doing not necessarily any more cuts anytime soon. And how should we be thinking about this? The Fed's on hold for a while, maybe even through the first half of the year, which has generally been our view for the last little bit. And then the press conference kicked in about half an hour later, and a few minutes into the press conference, Powell said something along the lines of, "Well, we were just cleaning up the language, and don't take what we said or didn't say about inflation getting to target, too literally." Um, And so the market essentially reversed on that a little
Okay.
bit. And then towards the very end of the press conference, he got another question in Q&A, again, kind of talking about March, which is the next meeting for the FOMC, the Fed. And he effectively said that we're in no rush to cut rates. So it was a bit of a ping pong match in terms of just the sentiment that Powell and the Fed were giving off. Net net, I don't think the Fed is in a huge rush to cut rates here.
Right.
And I would be surprised unless we had a big aggregate demand shock, or even something on the inflation side, but particularly an aggregate demand shock, or at least the perceived imminent issue of having an aggregate demand shock in terms of consumption or fixed business investment or both. I think the Fed's on hold in March and probably through the first half of the year. I will say, and again, this is a little confusing because Powell himself went back and forth a couple of times. He did reference the last two inflation prints, and we're recording this before the December PCE core PCE print, which we'll get on Friday. But that looks pretty tame. But the last two inflation prints have been also relatively tame. So even with a little bit of concern over inflation, the recent trend here is that it's been a little bit cooler on the inflation side. Of course, as we know, the last few years, particularly the last couple years, the inflation data in the first quarter of the year has come in generally hot, particularly the January data that we get in that prints in February, which we're obviously on the cusp of looking at over the next few weeks. And that's caught people, and that was very much the theme. Rewind 12 months ago, that was very much what was happening with markets and the economy, and what you and I were talking about. So I'm sure the Fed's watching that and concerned about that. But we had a unanimous vote today to do nothing and to sign off on the statement, which was which was a little bit interesting, particularly with Governor Waller having flipped and gone from being kind of the barometer on the hawkish side to being kind of an outlier on the dovish side. And that's anyway, it's quite interesting from a Fed watching perspective. But net net, again, barring an aggregate demand shock or something odd on the inflation side, I think the Fed is on hold here. Maybe one other thing just on U.S. economics and the Fed quickly. Obviously Trump is in office, and there are many things that are happening from a executive order perspective quickly. A lot of them are happening with immigration, deportation, the labor force, and not only public but also private. Um, Depending on what happens here over the next couple of months, with a few specifics within some of the mandates, if we start seeing the inability for illegal immigrants to get access to employment documentation, that is going to have a significant impact on payrolls, on non-farm payrolls, the usual headline number, 200, 250, 150, whatever, that number. And that could fall off relatively quickly. I'm not saying it is going to happen. I'm just flagging it to our listeners as a risk, because
Right.
if that happens, we're going to see payrolls plunge pretty fast, and pretty much there's a good chance whatever I just said over the last 5 minutes about the Fed could be a little bit in jeopardy, and the Fed could be looking at a labor market that is a lot cooler than it expected, and that would put cuts back on the table definitely before the end of the first half of the year.
Great. Maybe we'll come back to that point, but first let's talk about tariffs, which is
Okay.
another obvious priority for the Trump administration.
Yep.
And I'd like to really understand your view. As you said earlier, we're recording on the 29th. We have Saturday as the tariff deadline, so I don't want grand predictions on what's going to happen on the first, because there's a lot of different options. But I'm curious about what you think the Bank of Canada reaction would be to the various scenarios of tariffs, whether they're sort of across the board, or maybe selective, or maybe not at all.
Yeah.
So how would the bank think about that sort of policy response?
It's a good question, and there's definitely a bit of a market on it. Let's assume that there are large tariffs that are put on Canadian exported goods to the U.S., and then Canada reciprocates in kind. So it's significant, maybe the beginning of a trade war. Maybe it doesn't last very long, but it could be pretty serious for a few months or a few quarters. A lot of people would say that, well, there's going to be a spike in inflation, and therefore the Bank of Canada won't cut rates, and that may very well be true. And I think is a decent sized camp in the market that believes that. I think that's very fair. Not to get too academic, but when you talk about those kind of things, you kind of look at it, putting on my old economist hat for a while, which I haven't done, but you can look at it. You can use kind of two definitions there. One is called like a price level increase, and one is inflation. And they actually technically mean different things. A price level increase, which unlikely is as I'll describe it, is you kind of have a one-time increase in prices, and then inflation or the price of that good or service essentially is flat forevermore. So it's kind of a one and done, and that's it. And that in reality, that doesn't generally happen, but you can have a very, very small increase in kind of the climb of that price of that good after the original price level inflation. I remember winding back to when we started doing these podcasts a number of years ago, and it was this whole idea of kind of like level up, and I use that term level up a lot. That
Right.
was basically code for a price level shift. Like we're going to have a shift in prices, and obviously that impacted inflation as well. But you didn't see inflation come down, and so when everyone says, "Oh, my groceries are significantly more expensive," or my haircut's significantly more expensive, or pick any good or service, it's significantly more expensive. That price level shift, that was very much what I meant by leveling up as the first step. And so I think that from Bank of Canada perspective, the bank believes, rightly or wrongly, that if we have some sort of reciprocal trade war of size in terms of 15, 20, 25% or other, that it's going to be mostly a price level adjustment, and it's not particularly inflationary.
Okay.
And again, the bank may be wrong about that. I'm just talking about it from the point of your question, like how does the bank look at it? What is the lens with which the bank's going to look at it, and the likely reaction function? And if the bank doesn't think that there are long-term inflationary impacts, there might be a price level impact, but not an inflationary impact. What's probably going to happen is the bank's going to say, well, demand for goods and services is going to fall probably
Right.
significantly. And as I like to say, it's a shock to aggregate demand, or big aggregate demand decline. And so from the way the bank works, looking at, through its totem model and the output gap, and always managing the output gap. And again, the output gap basically is the economy running above capacity, below capacity, or within equilibrium? The bank, I think, would be thinking that aggregate demand would be aggregate demand gap, or the output gap, I should say, would be increasing, which basically means that demand for goods and services falls. And from that perspective, there's a risk over the medium term, maybe not immediately, but over the medium term, that prices could fall, inflation could fall, or at least slow significantly. And so the bank, I think, would want to be stimulative in that environment. And so I think the bank actually cuts rates. I think the bank actually cuts rates relatively significantly and quickly. And I think going back to this 2.25, 3.25 neutral range, like that's helpful, because it kind of says, okay, well, at 2.25, that's kind of the line where we think we're being somewhere between neutral and accommodative. So I would expect the bank to be cutting rates below 2.25%. And depending on the size of the tariffs and how long they may be going for, I would expect the Bank of Canada rate to get into the ones. So maybe 1.5%, again, depending. But it's much, much more than what is currently priced. And obviously, you'd see the currency depreciate. I mean, very
Sure.
likely you'd see Canadian dollar depreciate, and that readjustment of the open floating currency would help, obviously, buffer maybe some of that tariff and export issue. But it won't be the shock absorber of the open currency won't do it all. There'll need to be some accommodative, I think, requirements from the bank. So not everybody sees it that way, but I think that is the most likely path for the bank. If tariffs, if size, if reciprocal, all those things.
That's great. Good context. And in that scenario, and particularly as we're at sort of the opening stages of this, would you expect the impact on the Canadian curve to be anchored on the short end and sort of mid to long end remain unchanged at this point in time, or do you see the whole curve coming down?
It's a good question. I mean, it's a steepener in some fashion. The only
Yeah.
question is, maybe not the only question, but the big question to your question exactly is, can long end rates stay where they are? Would they come down? I think at least initially, we're probably looking at long end rates higher, because I do think the bank would cut rates. Very likely, we would have inflation, or at least the perception of inflation, even if it is a price level change, but the perception of inflation in the near term, 1, 2, 3, 4 months, that neighborhood.
Yep.
And so I think the initial reaction for the Canadian curve would be, the back end would be quite a bit higher in yield, and the
Okay.
front end would be quite a bit lower in yield. Although it may take a little bit for the market to understand the bank's reaction function and for the bank to do something. But that's what I would. I mean, depending on everything else that's going on in the
Yeah,
world,
of
but that's
course.
probably
Yeah,
what I
sure.
would be. That's what I would be playing for from a portfolio perspective in terms of alpha trades and active management. And very, very likely, I would be looking for that.
Great. I'd love to get your view on the Fed, as opposed to Bank of Canada, taking the view from Americans applying tariffs to various jurisdictions. And of course, a lot unknown, but what's your view on what the Fed's reaction will be to, let's say, reasonably widespread tariffs across several jurisdictions?
That's a good question. So I think the Fed and the Bank of Canada would look at these things relatively similarly from kind of
Okay.
an economic output perspective. So this is a price level change. This is not necessarily inflationary. Although my impression maybe is that the Fed might see this as a little bit more inflationary than the bank on the respective economies, but not massively. And so we need to at some point probably drop rates, because we're concerned about aggregate demand, we're concerned about consumption and the like. So I don't want to necessarily repeat myself, but I think it'd be a very similar thought process and
Perfect.
reaction function for the Fed. Where I think it's a little bit different is, I think, the underlying, and this is obvious, we've talked about it many times, the underlying economy in the US is obviously quite a bit stronger organically as we sit here today than in Canada. And so, said a different way, Canada's economy is probably a lot more fragile. So I think even if the reaction function, the directional reaction function is the same, maybe the magnitude isn't as much. So, if Canada's cutting Bank of Canada's cutting pretty aggressively, and maybe the Fed's cutting, but not as aggressively on an apples to apples basis. That said, we did hear Powell today say that I think he used the term moderately restrictive in terms of where the Fed funds is at 4.25, 4.5.
Okay.
I think he actually went through the whole thing. He didn't say it was. He said, "I don't think it's restrictive. I don't think it's highly restrictive." I think he said moderately restrictive. So that seems to suggest, and I would agree with that. R star, where is the neutral rate of interest for the U.S., is probably higher than where it is for the Bank of Canada, right? The
Right.
midpoint of the range that we just talked about, Bank of Canada's 275. Big debate on where it is for the U.S. I mean, it's probably 3.5, give or take. So, where do interest rates need to be for the Fed to be accommodative or neutral for the U.S.? My point is that that nominal rate of interest, or sorry, that neutral nominal rate of interest is probably higher. So even though, again, it's probably the same directional reaction function from a magnitude perspective, it's probably not as required. And I would expect, from a curve perspective, I would expect a similar kind of reaction function, with the front end yields coming a bit lower, and at least initially the back end moving a bit higher. The slightly more, I mean, it's always complicated, but the slightly more
Of course.
complicated thing in the US is going to be what's happening in parallel around the tax and tariff story, I guess, in terms of ERS and the fiscal story. And is that suggesting that there needs to be significantly more issuance in the back end of the curve, and has now officially nominated Treasury Secretary Bessent talked more about terming out the debt, which basically is just a fancy way of saying we're going to issue less T-bills and debt further out along the curve, whether it's 5 years, 7 years, 10 years more. And what does that mean? And I think that'll be important as well. And that story is not going away. So that's also a big driver in terms of the curve shape. But hopefully, in terms of directionality, I think it will be relatively parallel.
That's great context. I'd like to turn to equity markets. I know that your focus is generally on macro and fixed income, but we did over the weekend have DeepSeek come out, the Chinese sort of AI bot, where I believe it was trained on rechargeable AA batteries and some old photocopier chips or something along those lines, but significantly cheaper anyway than the existing American models. Stock markets declined pretty rapidly off of that. Any takes on this? Is it short term market reaction? Is there more to it than that?
Yeah, no, it's a good question. Obviously, it was a big focus for us on Monday and to an extent on Tuesday. And obviously, I sit in the fixed income team, and rates and FX are my primary focus, but we also do things with the odd thing with credit and
Sure.
SPY, options, and I sit on the global investment committee. And so, from an asset allocation perspective, these things are obviously of interest, and as is anything generally global macro, I think. I think it's significant insofar as the AI development in the world, and I'm certainly not an AI expert, but to your point, the capex that went into this apparently versus some of the capex that's gone into other large language models is obviously significantly different. And even since that news, we've had Alibaba come out overnight last night, and today's Wednesday, talking about a large language model that it has produced that apparently they said, not my words, but it said is actually better, again, not my words, better than DeepSeek. So you kind of get the idea of where this, we're off to the races here.
Right.
In terms of the ability. So I think one is the capex, which is interesting. Two is, are NVIDIA chips going to be as in demand, which I'm probably not the expert to talk about that, but seems to be obviously a re-rating or a recalibration in the stock price there, because some people think that's not the case. I think three, clearly the availability of this is going to probably only become more and more prevalent throughout the
Sure.
world in the adoption, because the adoption level is now significantly lower apparently than it was even maybe a month or two or three ago. And maybe just as interesting, maybe the most interesting thing take away from me on Monday, and again I'm reading just other people's thoughts and work on this. It's not my own proprietary, but the amount of energy that it takes to run DeepSeek in this particular case, what I thought was really interesting. I saw somebody say that it only took 3% of the energy to run the large language model than some of the other ones that we know. And I thought, wow, that is really interesting in terms of energy usage. What does it mean? You saw some of the utility companies have a rough day,
Right.
earlier in the week on the idea that it's not going to have as much energy or electricity consumed, that sort of thing. That was quite interesting. So there's a lot of takeaways there. Is this a story of kind of risk off? I mean, not in particular. I don't have it up in front of me, but there were some really interesting stats that I saw either late Monday or early Tuesday after the Monday sell-off. Things like the Dow is only 1% from its peak. Apple on Monday had its best day in 4 months.
Right.
I think 349 of the S&P 500 stocks were up on Monday. So now look at all that, and it goes back to your question: is this as I always say to myself, like, is this a thing? And I say to the group, like, is this a thing? And I look at all these things all the time and have to figure out: is this a thing? Is this a driver? Is this something we're going to have to really pay attention to, or can we kind of just put it to the side? Obviously, Gen AI is very, very important, and very, in terms of the evolution of how we all get and consume and probably, information and how we work going forward. But I don't think this is particularly a driver for markets, as it were. I mean, obviously Monday was a pretty significant down day, and
Sure.
and maybe some of these companies that are related to that space need to recalibrate a little bit. But I don't think this is going to be particularly a thing that is going to be a driver from a market thematic that we're going to be talking about 3, 4, 5, 6, 8 weeks from now. It's something I think that's important in terms of the fabric, but it's probably not a huge driver once we kind of get the recalibration in asset prices across some of these subgroups in a relatively short period of time. And the market now, partially due to AI, frankly, but just the way the market trades, particularly the equity market, I would say trades since the pandemic, it recalibrates very, very quickly, and
Yes.
that kind of longer lag that we saw, maybe for those of us that are a little bit older, earlier in our careers, it took maybe a lot longer time for markets to recalibrate. So it definitely speaks to the idea of having a well diversified portfolio, proper management of that portfolio, having some active management, some passive management, and making sure that your portfolio is properly properly hedged
Right.
across all asset classes, because there will be days where you're going to have some big drawdowns.
Good point there, Dustin. I know I only have you for a finite amount of time, but I do want to ask you about portfolios and anything going on within the portfolios. But maybe give me your top one or two ideas on what's happening in the portfolios.
For us, there's lots of stuff going on. I mean, again, we're recording Wednesday ahead of the weekend. We're not making huge bets on kind of what may or may not happen on Saturday, because the tail risks are just too fat, and it's really, I mean, no one really knows, and
Right.
it's a little bit of gambling. Some of it goes back to what I know I was saying a few minutes ago about reaction functions for central bank and kind of staying the course. And so if A, B, C happens, then this is what we're going to do. So we're kind
Right.
of in that mode, very much taking down a little bit of corporate credit, just kind of going into the event. No big surprise. From a macro perspective, we still like having a little bit of, especially in the U.S., inflation protected securities, so TIPS, as part of our overall duration. So a good chunk of our overall duration, at least U.S. duration, is going to be coming from real yields, not just nominal yields, which we think is important. I think inflation can be maybe a little bit sticky here. We've talked about that a lot over the last few quarters, and I think it is. And markets have kind of been trading that. From a global perspective, we really do like the New Zealand trade, and we have that on in a number of our portfolios, whether that's unconstrained or global, and a couple of the others, even Core Plus. We think that the New Zealand trade is really interesting, buying duration kind of around the 10-year part of the curve. Economy's in recession. The rates are still above 4%. Bank's probably going to have to cut rate. Doesn't have to cut rates, but bank's probably going to cut rates next month, 50 basis points. And it's probably going to get into a pretty significant cutting cycle. So and the currency hedge is relatively cheap. So you can still pick up really good yields well above Canadian rates, even with a fully hedged New Zealand dollar FX position against the Canadian dollar. So we really like that, and that's another way we are picking up duration here, particularly with all the uncertainty around North American rates, as we've talked about for this podcast and many others. For all the reasons that we know, whether it's the Canada story or the U.S. story. So that's a great play, I think, on our side. And we continue to do that. So those are some of the major ones here. I suspect we will have more trades on in the coming couple of weeks once we kind of get through the big event risk through this weekend.
That's great context, Dustin. Thanks again for sitting down, spending time with me, and walking through the latest market action. Really appreciate it.
For sure. Thanks very much again for having me on.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.